Hello, I'm Matt Cadnar from the Asset Allocation team and the NEVO team here at GMO. I'm joined by my colleagues James Montier, Martin Tarlie, and Ben Inker. James is joining us tonight from the UK. He joined GMO from the sell side about 12 years ago, spends his days at GMO as a researcher in the macro space, but also a committed value investor with an extensive background in behavioral finance. Martin Tarlie is on his second stint at GMO. He came back home about 4 years ago. Martin is a trained physicist with a PhD in theoretical condensed matter, and also spent time as an entrepreneur and a fundamental investor before joining GMO. And of course, Ben Inker, our co-head of asset allocation and a GMO lifer. So first, just want to thank you for taking time to be with us today to talk about investing for retirement and understanding and dealing with sequence of returns risk. You were kind enough, about over 90% response rate to our survey, so thank you very much for doing that. And I think it provides a nice framing for what we're going to talk about today. And the responses were somewhat split on whether you incorporate sequence of returns risk in portfolios, but it's fairly clear that advisors are concerned about sequence of returns risk and use some combination of cash or fixed income or some type of asset allocation to try and mitigate that sequence risk. And we certainly have seen many advisors setting aside an allocation to high quality bonds to try and help mitigate sequence risk. But with that as a backdrop, we're going to lead off with a question to you, James. So James, I know you love frameworks, and risk, or certainly managing risk, is central to any investment process. But in order to do that, we need a framework for understanding risk. So what are your thoughts on such a framework, and how does investor behavior fit into the concept of risk?
Cool, thanks, Matt. So let me start by talking about what I think we could call the fundamental precept of investing, which is in essence nothing more than one should seek to buy low and sell high. Yet despite that kind of trite sounding perspective, it's proved incredibly difficult for a lot of investors to actually do. As Warren Buffett has said, the idea is effectively simple, but just not easy. What we actually see is a cycle that is superbly captured by this illustration from Carl Richards, which actually hangs on the wall of my office back here. Which is, unfortunately, all too often investors have a tendency to buy high and sell low. Of course, if you keep doing this, you're eventually going to go broke. But what's behind this inversion of the way that we should approach investing? Or put another way, what is the psychology of fear and greed? Now, I could fill the entire time we have available today talking about this, but I don't think that would please either of my co-presenters, so I'll try not to. So in brief, when it comes to greed, it's really all about the fear of missing out, which, despite its name, is not really a fear at all, but rather just another manifestation of greed. Neuroscientific studies show that social pain, the pain of doing something different, of being left out, is felt in exactly the same parts of the brain that register real physical pain. So effectively, doing something different or being left out is akin to having your arm broken on a regular basis. So it's just simply not much fun. As the chart on the left here shows, even geniuses like Sir Isaac Newton are capable of being all too human. His experience during the South Sea bubble highlights just how painful it is to watch your friends getting rich and the disastrous consequences of then following a fear of missing out based strategy. On the other side of the cycle, during those periods when we're facing loss and we have that tendency to want to sell, or at least certainly not buy, that's because our brains and our emotions that are generated effectively stop us from investing after we've suffered a loss. The study I've used here is a famous one from Bechara and his colleagues, who studied 3 groups of players. Now, one of those groups had a very specific form of brain damage. They could no longer feel fear. They had significant damage to their amygdala, the brain center of fear. Another group had brain damage in parts of their brain unrelated to the system of fear. And a final group were the so-called normals. Now, each player was given an endowment of cash and then asked if they would like to participate in a series of rounds. In order to participate, they had to pay $1 from their endowment. If they said yes, they'd like to do it, a coin was flipped. If it came up heads, they'd get $2.50. If it came up tails, they'd lose their $1. Now, hopefully, it's obvious that it should be optimal to invest in all rounds. But look at the middle group of bars on the right-hand chart there. Here we've got the percentage of time that people chose to invest after a round in which they suffered a loss. As is very clear, the only group who behaved even vaguely sensibly after a loss were the group who could no longer feel fear. So these are the key elements, if you like, of the psychology of fear and greed. And these have really very, very real and serious impacts on investors' returns. This data comes from the Morningstar Mind the Gap study, and they compared the returns that a fund achieves with the returns that an investor achieves, effectively comparing time-weighted versus dollar-weighted returns, if you prefer. Now, due to those poorly timed decisions, this amounts to an average drag of around about 2% per annum. And that's a terrible handicap if you compound that over 30 or 40 years of investing. Now, I can almost hear Matt begging me to get to the point and answer his question. So how does all of this relate to the concept of risk? Well, in finance, we seem to have an obsession with the title of risk, but more often than not, it really comes down to risk measurement and the idea that risk is somehow a number. And as I've said countless times before, risk really isn't a number. It's not standard deviation. It's not volatility. It's not beta or beta. It's actually a much broader concept than that. And I think to really understand risk, it helps if you start by asking the right questions and caring about the right things. And to me, risk is really all about the chances of suffering the permanent impairment of capital, losing money and not being able to get it back. And there are three basic paths that lead to that outcome. Two turn out to be characteristics of the investment you are making. That's valuation risk and fundamental risk. Now, valuation risk is simply buying an expensive asset. Think tech stocks in 2000 or Japanese stocks in 1989. Expensive assets are very likely to fall short of the expectations that investors have embodied in those prices. As Ben Graham put it, the market has a tendency to set prices that will not be adequately protected by a conservative projection of future earnings. Now, hand in hand with that goes the concept of fundamental risk. This is the risk that the cash flows you've assumed are simply not delivered. Ben Graham talked about it as the danger of loss of quality or earnings power through economic change or a deterioration in management. At GMO, we often talk about depression risk for equities as an asset class or inflation risk for fixed income as an asset class, as the deep fundamental risks that investors are effectively underwriting. But there is a third way to permanently impair your capital, and that is via your behavior. This is, I think, where the kind of academic perspectives on risk and the practical perspectives on risk kind of diverge. So fundamental risk and valuation risk, yep, academics are kind of at least vaguely aware of. But financing risk gets much less coverage. And it clearly isn't related to the nature of the specific investment you are undertaking. It's all about the way you behave, how you time your decisions, when you buy, when you sell. It's really, financing risk is really anything that forces you to exit a position before you would do so on investment grounds alone. In the academic literature, when financing risk is discussed, which is rare, it is usually only mentioned in the context of leveraged portfolios, where you can be forced to effectively buy high or sell low because of the borrowed nature of the capital you're using. However, I think that, in fact, financing risk is much more prevalent than that very narrow perspective that it gets lumbered with in academic finance. So I think when we're thinking about risk, we really need to think about all of these dimensions of risk and finding tools that help you understand and even better manage all three elements of risk is really vital.
Thanks, James. I love Newton's quote, "I can calculate the movement of stars, but not the madness of men." And James does feel quite passionate about risk not being a number. When we have interns or new members of the team, and if they somehow misspeak and talk about risk as a number, James is known to become irate with them, which is somewhat terrifying for the newbies. But they become used to it and they learn that lesson. But James, so that certainly helps us define risk in a way that's certainly more intuitive than volatility or some risk aversion parameter in an optimization. But in the most recent Investing for Retirement white paper that you gentlemen wrote, you talked about sequence risk as a form of financing risk, which to me does seem like a unique way of framing it, because as James mentioned, finance risk is generally associated with leverage. But Ben, can you explain what you mean by sequence risk as a form of financing risk?
Sure, happy to. And I think you're right. Sequence of return risk falls into this little gap where it doesn't get talked about very much, right? We've got behavioral finance, which tends to focus on those forms of risk which are driven by the investor and his or her biases, and James was just talking about that. And the rest of academic finance tends to focus on the risks inherent to investments and generally ignore the role of the investor. The tricky thing about sequence of return risk, it's at the intersection of investment risk and investor risk. It's different from behavioral finance risk because it doesn't stem from irrationality on the part of the investor. It comes in whenever the investor's portfolio is not in a steady state. So if we look at sequence of return risk as a financing risk, you can think of three different situations. In the first situation, there are no cash flows into or out of the portfolio. You start with $100, and whether you make 10% in year one and lose 10% in year two, or lose 10% in year one and make 10% in year two, you wind up with $99. There is no sequence of return risk. It doesn't matter in which order those returns came from. But as soon as your portfolio moves out of steady state, the sequence of returns matters. If you withdraw $5 at the end of the first year, well, then you want your high returns in year one. To go back to James's first slide, you want to sell high. You are a forced seller at the end of year one, so you want high prices when you're selling. If you get your high return in year one, you wind up with $1 better than you would if you got the loss in year one and the gain in year two. Now, if instead of taking money out of the portfolio, you were putting money into the portfolio, well, you're not going to be selling, you're going to be buying. And you always want to buy low when you can. So in that case, the investor would be better off if you experience the losses in year one, and therefore we're buying at the lower price. So it may seem as if the only thing that matters here is there a cash flow? In order for there to be sequence of return risk, there needs to be cash flows. Without cash flows, there isn't sequence of return risk. But when we think about trying to manage sequence of return risk, it's important to understand that the magnitude of sequence of return risk is driven by the volatility of the portfolio. In my examples here, we had returns of +10 and -10. If instead of +10 and -10, we had returns of +1 and -1, the differences between the resulting portfolios, instead of being $1, would only be 10 cents. If instead of 10% returns or losses, we had 25% returns or losses, the difference in the outcomes would be 2.5 times as large. So sequence of return risk hits as soon as you've got cash flows into or out of a portfolio, but they matter a lot more when your portfolio returns are highly volatile. And they're just not that big a deal when your returns are relatively low volatility. So very few portfolios are in steady state. And certainly when saving for retirement, there's basically no steady state. There's either flows in or flows out of a retirement portfolio. So what can an advisor do to try to help come up with a better outcome for investors? There's basically two ways of dealing with sequence of return risk that can help. and they're not mutually exclusive. The first one is to frame your risk in a sensible way. Make sure you are asking the right question and you are building your portfolios through a process that understands the cash flows and the problem you are trying to solve. The second is to move your assets, effectively buy low, sell high, as James was saying. I'm going to talk about the first one first. So single period portfolio construction and mean variance optimization is kind of the classic example of that. Can't do anything about sequence of return risk for a very simple reason. In a single period, there is no sequence of returns in the first place. So the idea of sequence of return risk just doesn't come up. So you really need to build your portfolios understanding the multi-period nature of the problem. So you might think that just any multi-period portfolio construction process can do it. You do need something more than that. You need your process to be aware of the expected path of cash flows into and out of the portfolio. As Martin is going to show in a couple of minutes, having such a process like the needs-based optimization used in our NEBO platform can reduce the impact of sequence of returns risk for investors and lead to better outcomes. This chart shows what such an optimization naturally does for a retirement portfolio as the investor moves from a mode where cash is coming in on a pre-retirement to a mode where the cash needs to come out every year to fund spending in retirement. An advisor with a number of years of positive cash flow ahead of them can afford to hold a more volatile, more equity-focused portfolio. In that case, the bad events from a sequence of return risk, when the portfolio is taking near-term losses, are mitigated by the investor being able to buy low in subsequent contributions. As that period of future contribution shrinks, the near-term volatility of the portfolio becomes more problematic, and the recommended portfolio moves meaningfully down the risk curve, as you can see here in the red circle. But it's worth recognizing that even at retirement, the optimal portfolio is still pretty equity heavy. That does lead to more sequence of return risk than you might have due to the relatively high volatility of the portfolio. But that's compensated for, particularly early in retirement, by the fact that there's still a long time horizon for the overall portfolio. So there's more time for that relatively high expected return to pay off. Making that optimal trade-off between sequence of return risk and expected return is really hard to do by hand or with an Excel spreadsheet, but the right portfolio construction process can do it for you. Now, it is possible to do even better than simply building your portfolio recognizing the existence of sequence of return risk. But unlike the use of an appropriate multi-period portfolio construction process, it does have some downsides to it, at least from a psychological perspective. The way to move beyond an optimal glide path involves reallocating your portfolio as expected returns shift, as we can see in this chart. But this requires fighting against the behavioral biases that James showed most investors are guilty of. If we go back to our triangle depiction of risk, a crucial way of improving the financing risk, which is embodied in the sequence of returns, is to understand and react to volatility that is driven by fundamentals risk, the shifts that are driven by changes in the expected cash flows of an asset, treating those differently from the volatility that comes from valuation risk, which is the changes in value that comes from a changing required return to that asset, holding its cash flows constant. So a great example of what I mean by this valuation risk is what's happened to the 10-year Treasury note this year. The U.S. Treasury issued a bond last November with a coupon of 1.375%, maturing in November 2031. When it came out, it was priced at about par. Today, it is quoted at a price a little bit over 81, having lost more than 17% in the last 11 months. The cash flows of that bond are exactly the same as they were at issue. There has been no fundamental impairment of the bond. All of those losses were driven by valuation shift. And that 17% loss means that the return from that bond going forward has risen from the 1.4% at issue to 3.8%. An allocation to that bond, which made sense for an investor last November when the bond was offering a 1.4% return, is probably not the allocation that makes sense today when that bond is offering 3.8%. Taking advantage of such changes in available returns requires dynamically shifting portfolios over time, buying low and selling high, not just for the required cash flows into or out of the portfolio, but for the whole portfolio. That sounds easy, but it's harder than it seems for the behavioral reasons that we talked about. Buying assets that have just lost money is hard. Recency bias makes them feel particularly risky, and clients who are nursing losses are generally reluctant to take on more risk with their smaller portfolio, even when that's the right move to take. In fact, value-driven dynamic asset allocation is psychologically hard enough that people use all sorts of heuristics to trick themselves and their clients into doing it without feeling like they're doing so. Techniques like bond tens, bucket strategies, raising equity, target equity levels as clients age are all theoretically suboptimal strategies, but they can lead to superior outcomes for advisors and their investors because they push them into making portfolio moves that would otherwise be behaviorally quite difficult to commit to. But if you want to do the best you can for your client, the best way to do that is, in the long run, to dynamically reallocate the whole of the portfolio to take advantage of that volatility which is driven by valuation risk. Now, this is true even for problems that do not involve any sequence of return risk. But the advantage of moving your assets is even larger when you combine it with a portfolio construction that understands sequence of return risk. Martin is going to show in his Derby how that is the case.
Thanks, Ben. So turning to Martin, we've been through a couple periods in the last decade plus, and we certainly appear to be going through another yet again, where we've had some pretty significant drawdowns in equity markets this year. As Ben points out, a drawdown in the bond market too. So can you walk through some examples of how the shortfall approach would have done during these tough times?
Yes. Thank you, Matt. Thank you, Ben. I'm going to start by sort of laying out the Derby, setting out the stage. So in this Derby, we have three horses. Two horses you've already seen. The first is this optimal expected shortfall glide path, where the weight in equity starts at maybe a little bit more than 60% in stocks and then falls to about 30% at age 95. The other horse that you've already seen is the one where the weights in both stocks and bonds are adjusting based on the relative attractiveness of either stocks and or bonds. The third horse, which is shown in the upper left-hand side, there is really a common glide path that's a cartoon of a glide path that you'll see often by large purveyors of glide paths. So in this case, for sort of the post-retirement phase, somebody who's 65 has about 50% in stocks that falls to about 30% when they're in their early 70s and then stays flat at that level. Now, there's nothing inherently wrong with that common glide path. The really big problem with that common glide path is we don't exactly know what problem is being solved by that particular glide path. Actually, back in 2013, Ben and I started looking at the problem of glide paths, and we tried to understand how purveyors of glide paths were actually constructing them, and we had a really hard time. And it was that necessity of trying to understand how to build a glide path that led to this concept of what is risk and the notion that risk is not having the money that you need when you need it. And the last 9 or 10 years or so has really been about fleshing out that idea and building a framework around that. So what we do to compare these three horses is we start with an investor just retired at age 65, and then every year for the next 30 years, we assume that they withdraw $50,000 in real term every year. Our first test is to run a historical back test using the Robert Shiller data from the late 1800s. And if you see in the upper part of the panel on the right-hand side, if you withdraw $50,000 a year every year in real terms, starting with $1 million, if you follow the common glide path, you run out of money an alarmingly high percentage of the time, 51% of the time. However, if you follow the optimal shortfall glide path, you can cut that down to 25%. So roughly in half. Now, the key point about this optimal shortfall glide path is that we understand what problem is being solved here. In this particular case, the glide path is minimizing shortfall relative to compounding wealth at 3% over inflation. And that problem is tuned to the kind of withdrawal rates that you're seeing illustrated here. If you take the next step, Ben articulated, which is you also move your assets. When stocks are attractively priced, you own more stocks, and when stocks are not attractively priced, you own less. You can cut the probability of ruin even further. Now, to test whether or not the historical results were a fluke, you can also run Monte Carlo simulations. And I'll just note that these Monte Carlo simulations that we run incorporate important mean reversion effects that are embedded in the historical returns that, for example, the volatility of profiles for stocks rises more slowly than it does for bonds. And if you just assume random walk when you run your Monte Carlo simulations, you'll miss that important effect. But basically, we see a similar pattern when we run the Monte Carlo simulations. By asking the right question, you can cut the probability of ruin approximately in half. And by moving your assets, in addition to asking the right question, you can cut them by about another third. So that sort of sets the stage for then looking at a couple of examples to bring these sort of statistical results further to life. Arguably, the worst time to retire was the late 1960s or the early 1970s. So the 1970s wasn't really just about bad hair. It was about bad asset returns for both stocks and bonds. So in the left-hand chart here, what we're illustrating is the path your wealth would take for all three of those horses. What happened in 1974 was a significant stock market crash. Both the optimal shortfall and valuation-sensitive optimal shortfall glide paths lost significantly more money than the common glide path in the crash of 74. However, just a few years later, both of those strategies had recovered the majority of their losses. The problem with the 1970s was both stocks and bonds did very badly on a real return basis. So while stocks lost about 40% over a short period of time, bonds in real terms lost about the same amount over the entire decade of the 1970s. So the common glide path was really handicapped by both poor returns on both stocks and bonds. And in the right-hand side, you can see by the time the investor reaches age 88, they've run out of money. In the optimal shortfall case, it wasn't quite as bad because the extra return on stocks benefited and the investor could consume out of those. But the valuation-sensitive optimal shortfall had a substantially improved performance. And the reason was, by the time that the early 1980s came around, stocks were extremely cheap. And a large weight in stocks and the high subsequent returns in stock allowed the valuation-sensitive investor to consume out of those stock gains. And in fact, in this example, never run out of money. So that's the 1970s and these sort of inflation effects of bad returns on both stocks and bonds. Somebody retiring in 2008 faced a rather different scenario. In that scenario, which is perhaps the psychological framework that drives a lot of sequence of returns fear, stocks were down about 50% right out of the gate for somebody retiring in 2008. So the optimal shortfall strategy lost about $100,000 more than either of the valuation-sensitive optimal shortfall strategy or the common glide path. So focus for the moment on the solid lines. So the optimal shortfall loses about $100,000 more than the common glide path. But by about 2013 or 2014, you can see there's an upward red arrow there. The optimal shortfall glide path has basically caught up with the common glide path because that extra equity weight and the subsequent positive equity returns are really driving the value of that portfolio. As time marches on, the optimal shortfall strategy also eventually catches up to the valuation sensitive optimal shortfall strategy. So you can see the downward red arrow on the right-hand side. So the valuation sensitive optimal shortfall strategy does quite well from 2009 because it lost less money than the optimal shortfall strategy. However, because it is sensitive to equity expected returns, and equity expected returns, at least in this framework, were relatively low over this period, eventually the optimal shortfall strategy catches up. So when we've shown this particular graph to advisors, advisors find this very appealing because they have a variety of different clients that they speak to, and they're interested in calibrating different types of strategies for different types of individuals that are able to bear the sort of behavioral consequences of being valuation sensitive. They can use a graph like this to illustrate the types of scenarios that the person might encounter. And that sort of leads into the last point I want to make, which is what we've illustrated until this point is some somewhat academic results about sequence risk and how one might mitigate it. But we've actually built a platform that takes that theory and puts it into practice. We call this the NEBO platform, and it really operationalizes a lot of the ideas that we've been talking about. But it really operationalizes it in a way that allows the advisor to customize it for each individual, and wrapped up in this umbrella of minimizing shortfall and allowing the advisor to practice as much valuation sensitivity as they like, or as little valuation sensitivity as they like. And in the end, it's really about aligning the client's financial plan with the portfolio that they own.
Thanks, Martin. I know we're just about at time. I did want to sneak in a quick question here. How is expected shortfall risk being defined? Is it one number across the lifelong, or a snapshot number at each age?
It's the easiest way is to explain the definition in a couple of examples. So for somebody who is retiring at age 65 and expecting to live until age 95, it's minimizing shortfall over that entire expanse of time. And it's minimizing shortfall relative to a level of wealth. So we're not minimizing return shortfall, we're minimizing wealth shortfall. Another example that might also illustrate it is if you're saving for college. So if you have a child born now, you're going to save for 18 years, and then they're going to spend from 18 to 22. It's minimizing shortfall in those spending years. So it would be minimizing shortfall of wealth over the years 18 to 22.
Great. Thanks, Martin. Just to wrap up here, James has taken us through some of the behavioral issues that we all face in thinking about risk. Ben has framed the importance of addressing sequence risk by asking the right question, in this case, framing risk not as volatility, but not having what you need when you need it, and then also moving your assets, buy low, sell high, simple but easy, but not simple but not easy, as Buffett and James famously said. Martin's has gone through some examples of shortfall. I certainly always love reliving the global financial crisis, but then also how we operationalize NEBO. And unfortunately, there is no silver bullet for sequence risk, but we believe by asking the right questions and moving your assets, you can help mitigate this risk. And we've embedded those critical concepts in the NEBO platform. NEBO is a product of a 3-year user-led development process where we engaged with advisors to define the feature set that most helps them manage portfolios and build their business. What we've heard from advisors is that NEBO helps them align the portfolio with their financial plan in a tangible way. This inspires confidence that advisors are putting the clients in the right portfolios. And NEBO does this efficiently in an open architecture framework. And as one advisor put it, NEBO does in minutes what used to take me hours, which was indeed music to our ears. If we did not get to your question, we will follow up with you after the webcast. We encourage you to visit our website, www.nebo-gmo.com, or just Google NEBO GMO, or reach out to us if you'd like to learn more. Thank you very much and have a good afternoon.